All right, so the big news this week. Okay, let's look at our calendar. Okay, this week we're approaching a holiday. Usually around a holiday, you have people get happy and they start buying. So I expected next couple days in the stock market to be positive days, but we counteract that with the last 2 weeks of February are the worst weeks all year long for the last 100 years. So that is a contradiction, but we're going to go with it. There's earnings for Nvidia coming out on Tuesday. So based on what happens there, the stock market could go up or go down. And there's a lot of indication that they're going to go up because a lot of companies that deal with Nvidia say that they have a lot of orders, etc. So people are kind of figuring out that it's going to be a good earnings report. But that's going to basically rule all next week. We're still overbought now. We're still overbought. You can see we're starting to go down just a little bit. We had a little scare this week. There was 2 reports that gave us a hint on inflation this week. That happened on Tuesday and today. And both of them were showing a little bit more inflation than the stock market was expecting. And that makes the interest rates go up. And our formula for interest rates, if the interest rates go up, usually the stock market goes down. And we have like a simple little formula. Let me get this formula here. Okay, U.S. Treasuries, yields, if they go up, companies need to borrow, go down. So the companies with a high amount of debt usually suffer greatly. And the companies that will be steady are the ones like the big companies that we're following. They don't need to borrow money. They're well capitalized. So the healthcare companies are okay because they have steady demand in good times and bad. Companies that pay dividends, they're in less demand if the interest rates go up. Because if you can get a 5% yield on a treasury, which is risk-free, why would you buy stock with 4% yield? All right, so that's the big picture. But this week we had 2 reports showing inflation was worse than expected. So the treasury rates went up across the board. Okay, let's look at the treasury rates now as in the middle of the day. I didn't realize how important treasury rates are to the stock market, how much people are willing to pay for the stock market, but it's starting to be a one-to-one correlation. Let's look at that right now. You can see this, each one of the treasuries are up today. So that's not good. But that just affects the interest rates that are going to be lowered later on this year. Okay, let's look at our big picture in the stock market today. Okay, we have, this is a lot. So the 10-year is going up. We had some reports today on Eli Lilly. They're raising their price target on Eli Lilly. Let me see. The $9.50 from where it's at right now. So Wells Fargo. Okay, and they were saying, let's look at Eli Lilly just for fun. You can see it's has numbers of a growth stock. They're growing around 30% a year, and it's being added to a lot of mutual funds we've been noticing, growth funds. So that's a good indication that it could be a good stock to buy and hold. And let me see, let's look at the more of our notes here. What is going up and down? Let's see. Okay, what's going up and down the stock market today? So the interest rates are going up. We expect the top decliners to be ones that are heavily involved in borrowing money. So let's see. Let's see, the ones going down the most today. Tech is going down a lot. We have tech, we have Adobe, we have Meta, we have, you see, I don't see that a lot of borrowing companies there. The ones going up the most are semiconductors. Semiconductors, Applied Materials, they had a good earnings report, and KLA Corp, they're and Lam Research. They're all semiconductor companies. Eli Lilly is up from that price target upgrade. Let's look at NASDAQ. Okay, there's companies that, there are some companies like Trade Desk that are not profitable that are turning to be profitable companies. So I don't specialize in that. I like to look at stocks with earnings, but there are stocks like Coinbase and Trade Desk and Open Door, DraftKings, companies that aren't profitable yet that now are starting to be profitable. As soon as that happens, they jump like 20%. So let's look at, okay, there's a lot of ASMLs, Semiconductor, KLA, Tencor, Lam Research. Okay, so the theme here is people are pretty excited about NVIDIA's earnings report on Tuesday. So all the related companies are going up too. And the ones going down the most, these are all, a lot of these are high PE stocks. Google's going down because there's a lot of talk about AI. OpenAI is making a search product that might compete with Google. So people are afraid that they might lose their market share. I'm not sure about that. Okay. I think that's all I can get from that. Let me see. Can't get anything else from this. All right. Okay, so let's look at some of our you have the sectors that are going up and down today. Sectors, here it is. We expect ones with high interest rate sensitivity to be down the most, and the ones with least to be up the most. So communication services, these are all the ones that went up the most last year. Real estate is very sensitive to interest rates because people don't, it costs more to buy a house and pay a mortgage when the interest rates go up. Technology, a lot of technology companies are borrowing money to fund their activities, industrials, financials. And the ones doing the best today are materials, health. Okay, so we know that there's, when we looked at the beginning of the year, let's look at our worst to first. Okay, so we had last year, utilities, consumer staples, healthcare, real estate, and financials did the worst. And we're starting to keep track of, we're expecting to see maybe a flip of that, maybe these doing the best this year, the ones that are worst doing the best this year. But right now, information technology and communication services are doing the best. And we also see consumer staples, energy, and healthcare doing really good too. So that's kind of, we're seeing the health ETF or sector doing good because it's starting to get back into favor. That's good. That's a good, you see NASDAQ. Okay, that was good exercise. All right, let's go back to our talking points. All right, so yeah, next week we're going to have NVIDIA earnings, and after that, the earnings are basically done for until the next quarter. Then we have a good month of March. Usually this is one of the best months of the year. So that's why in the last week of February, it looks like it probably go down because it's one of the seasonality, one of the worst months of the year. These actually last 2 weeks are the worst weeks of the year. So, but then in March it's supposed to be pretty good. We have FOMC meeting coming up, so we might have some catalysts for the stock market if they decide to talk about the interest rates good or at that time. All right, so now let's look at, we do still have momentum. It's kind of steady. The number of stocks over the 200-day and the 50-day moving average is around 70. That's really good. And people are still excited about the stock market and they're bullish. The big picture is NVIDIA's reporting their earnings and we're still overbought. And that could change in a big way if NVIDIA has a bad earnings report on Tuesday. So US dollar is actually going up a little bit. I made a mistake there. The US Treasuries are going up. So that's really bad for the stock market. They went up 3% since last week. And usually there's a one-to-one correlation, but lately it's been not as accurate. But today was accurate when the interest rates went up, stocks went down. All right. What else do we have here? There's a lot of corporate buybacks recently, so that's helping prop up the stock market just a little bit. All right, so let's look at the monthly returns. We're going into March. It's one of the best months of the year. So I'm expecting at the end of February things will change, and then we'll have some positive activity in the stock market. And that's worked. This formula has worked out perfectly last year. Last year, August, September were bad months. So you got to prepare for that, and because everyone knows that's the time that people are selling. Okay, S&P, we're basically overbought, still overbought. We're just kind of at the top of our range. That's why I think in the next week or two we can go down. But overbought is just an indication that people are excited and they're buying. So that isn't a bad thing. It's just you don't get caught when everyone else is buying, because that's whenever the smart money sells. All right, so we still haven't. We had an inverse correlation here for a long time. Look how long that's been. All of a sudden, we see as interest rates go up, we see the S&P has gone up. So that, as of last week, that correlation failed to be consistent. So I'm not sure why. We might not be able to rely on that anymore, because if we see treasuries go up in a day, usually we can predict the stock market's going to go down. But that correlation is starting to not be good anymore. All right. So these are two reports. These are two inflation reports, the CPI and the PPI that came out this week. And they're basically saying that inflation is hot. And that's not so good. And usually my little translation, I already mentioned this to you, interest rates go up, companies that need to borrow usually go down. And right now that includes biotechs, small caps, and companies that aren't profitable, companies that need to borrow money to continue. So this is working today. The rates are up, and most small cap stocks and et cetera are down. All right, so we don't have much changes in any of our variables in the stock market. If the price of oil hasn't changed a lot, I'm surprised because there's so much activity and wars over there in the Red Sea and everything. So but if this spikes up, that's going to really hurt the stock market, because the higher the price of oil, the higher price of almost every good that you buy because of transportation costs, etc. So we're going to keep our eyes on this oil, and then hopefully it'll stay down. But if it does go up, that means the stock market will start suffering their earnings. Okay, so inflation is now 3.1%. That was from our recent reports. And the US dollar isn't changing a whole lot. So that's positive for a lot of the big companies that are reporting their earnings. And fear and greed, people are still greedy. They're extreme greed. So last week it was greed. So that means that people are just buying a lot. It's going to be really hard to maintain this buying. Trees don't grow to the sky, so eventually stocks will go down. So don't get carried away buying things, especially the high-flying stocks. And I'll mention a couple of those later on. But right now, people are extremely greedy, and we're going into the 2 worst weeks of the year, so that's pretty dangerous. The AAII sentiment, people are still bullish. That means it's a contrary indication. If it's bullish, caution. Take some profits or don't buy. Okay, so now US dollars is actually going up in the past since January, beginning of the year. So that's bad for the stock market for multinational stocks. So let's hope that this continues to go down then the profits will be better for the big companies. The VIX, people are not scared right now. They're actually, there's a good portion of the population buying calls right now, which means they're using options to buy. They think the stocks could be going up. So people are not really worried right now. We had a little bit of a scare with these inflation reports this week. That's why it went up just a little bit. But we'll see what the inflation how it pans out. Now we're kind of extreme greed right now, so we don't have a whole lot of pending issues that may cause a crash. Nothing this week really materialized. We have a NVIDIA earnings report coming up, and that's bad. And in a major way, the stock market will crash, and all the AI stocks around it will crash. And that could be that would involve Microsoft. It will involve NVIDIA. It will involve all the semiconductor stocks. So right now, price of oil is still good. It's still low, and we're rooting it to stay low. Okay, everything else is pretty much under check, and we don't have any major banks failing. So right now, nothing major. Okay, so I already went over this. The worst at first. We're actually seeing a lot of the stocks that underperformed last year starting to do good this year, especially healthcare. I see a lot of stocks in uptrends in the healthcare industry, and that looks like it's going to be a new leader this year. And financials are doing good too. Wells Fargo had good news recently, and they went up like 6 or 8% today. Let me see. So we still have news today. The weight loss drugs are taking the front page. The Eli Lilly, they said the price target from $700 to $950 because they think this weight loss drug is going to be super popular. All right, so utilities are still not doing good. It's one of the worst sectors this year. In real estate, probably because the interest rates didn't go down as much as they expected. All right, let's look at. We're gonna look at that. I'm keeping track of Dan Niles' beginning of the year picks. Beginning of the year, he chose Amazon, Meta, Texas Instruments, XPI, the biotech ETF, and KWeb. This week we thought we were wondering about these ones, which were not doing so good, the KWeb and the XPI, but this week they both rose a lot, 4.5% and 6%. So it's turning out these are actually going to be contrary plays. The KWeb is the Chinese ETF. No one wants Chinese stocks, and it just at that point in time, it could be a time to buy it. It's not for me because I can't value them, so I stay away from them. All right, so that was a good little exercise. Here's some charts that I found as I was doing my stochastics charts. I found that uranium ETF, it's in an uptrend. It's near the bottom of its range in its channel, and it's oversold. So it's not. We don't have that many things we're following that are actually, a good point to buy. And let me see. AT&T is very similar. And Verizon, they're both at the bottom of their trading range, and they're oversold. And Verizon, same exact chart. So they're oversold and at the bottom of their range. And Amgen, the healthcare company, they are also oversold and at the bottom of their trading range in the channel. So this has been a very reliable channel for over a year. So that's why I'm pointing these things out. Okay, so there's another article here that says NVIDIA will put the stock market meme to the test. There's a stock Matthew brought up last week called Supermicro, and this company it's basically gone up 300% this year, and it reported earnings recently, and and it's basically getting a lot of business from NVIDIA for data centers. I think they're a hardware company, and it's basically the stock where everyone's trying to load up on it, and it's super dangerous because if it keeps going up like that, eventually it'll go down, go down to here. Because if you look at this chart, you calculate where is the average right there. It'll probably go back down to here eventually, but what I did was I looked at their financials. They're a smaller company. And to see if it actually made any sense, their current stock price. So I looked at their stock price. They grew 200% from last year to this year, and that's due to the data center for AI, like NVIDIA. They use NVIDIA's chips for data center hardware, and they grew a lot. But I looked at the next year estimate. It's only 33%. So if they're growing at 33% and the PE is 78, they're like 2 times overvalued. So the real price, it should be trading at something like $500. It's growing at 33%. So, but we don't know that at all. It could be, they could be growing consistently at 200%, where if it was trading at a PE of 78, growing at 200%, that's a bargain. It'd be like, one half off. But right now it's 2 times overvalued, so it's pretty dangerous buying it right now. But it's interesting to go through that exercise. I went through Yahoo Finance to find out some more information. They only have a $56 billion market cap. It's a really small company, and their PE, you can see by this chart right here. Let me make this a little bit bigger. You can see that they basically, this is called margin expansion. This company has had the same PE ratio, 23, 24, 26. It tripled its PE ratio. That's called margin expansion. And people are paying more for, for their company. They're not actually growing. Are they growing as much? Let me see. Where's the book? Okay. Well, that's called margin expansion. So they are growing a lot from last year to this year, but can they grow more? We don't know, and that's like a guess. The people that know, that are analysts, say it's only growing at 33%, so it's pretty dangerous. The profitability is decent. We like 11 or 13. And return on equity is 30. It's not something special. It's great, but they don't have a whole lot of debt. You see their market cap is 56 billion, but their debt is 325 million. So that's a small portion of that if you subtract the total cash from the total debt. So that's manageable. If this stock had more debt, it would be under pressure today because of all the interest rate problems, but it doesn't have that much. All right, so this is a good time of the year for people interested in finding out what really smart people are doing with their portfolios. At the end of every quarter, companies that have over 100 million in investable assets, like mutual funds or Berkshire Hathaway, they report the buys and sells in their portfolios. So I thought it'd be interesting to go over all the changes that that happened in the last quarter or so for major mutual funds, and of course Warren Buffett's company. He sold 1% of his Apple position, and that isn't a whole lot. There could be a lot of reasons why he did that, but people are just ganging up on that, saying, "Oh, Apple is, their time is over. It's time to sell the company." And you see, hold on for a second. Okay, and so what we're going to do is look at the other side, maybe why he sold, his Apple position. We know from looking at this for a past couple of months or so that Apple is like 3 times overvalued. It's only growing maybe at 3 to 7%, but it's trading, its PE ratio is, its PE ratio is 30, it's growing at like 7. So it's 3 times overvalued. So that's the first thing. They have a deal with Google for search where Google's paying them $18 billion a year. And they might lose that due to this antitrust the antitrust thing that's happening with Google right now. Other thing is there's nothing exciting in the iPhone. There's no big changes in the iPhone. There's competition for their iOS in China, and they're starting a USB-C cable in their newer phones. That means they can't charge $30 for a accessory anymore, because everyone can make USB-Cs. And let me see. There's all kind of, they have OpenAI App Store that could eat into Apple's App Store. So there's all kind of, I listen to them all here, all these possible reasons why. This is from Felix Wang. And possible concentration of all their manufacturing in China. What happens if something happens in China or Taiwan? So those are some of the negative things. I'm very much considering reducing my position in Apple because I've held it for 15 years or so, but it's getting really big in my portfolio and they're not growing anymore. So I haven't decided to sell it yet, but it's getting close. All right. Okay, so this is this guy I follow. It says the S&P is now entering the worst 2-week period of the year based on data going back 100 years. So there's very good indication that we're overbought right now. We're going into the 2 worst week period of the year. So it's a good time not to get over your skis. All right. Here's some more. Hold on for a second. Okay, here's some more valuation look at the top stocks in the stock market. We have Apple, Tesla, Microsoft. This is what we were saying for a while. Apple has a 3 PEG ratio, so it's 3 times overvalued. Tesla is overvalued by 2 times, Microsoft by 1.5 times. But NVIDIA and Meta, believe it or not, they went up the most in the last year, yet they're still the least expensive. NVIDIA is actually 0.7. They're like 30% undervalued according to this guy on Twitter, a bar chart guy. All right, so that kind of matches what we've been saying for a while. And that's another reason why I'm considering selling Apple, because it's 3 times overvalued right now. And sometimes whenever stocks get overvalued and they can't justify their earnings, they'll have a big price adjustment if something bad happens. So we don't have a catalyst for that right now, but I'm considering that. So like I said, at the beginning of every quarter, or at the end of every quarter, the top mutual funds, top people managing money, they report their changes in the portfolio. So I thought it'd be interesting to see some of our favorite mutual funds and what changes their bid in there. So with the red, these are the ones that they sold, and this is Contra Fund. They sold CRM, that's Salesforce, and they sold Visa, Adobe, and Netflix. And they bought more Meta. They basically doubled their position in Meta. This is since 1.5 years ago. NVIDIA, they bought more. They established a brand new position. Apple, they have the new position, and Eli Lilly has a 2.66%. So I'm seeing Eli Lilly in a lot of these mutual funds. These are funds that are penalized if you buy and you sell a lot. So this is a good indication, just a confirmation that Eli Lilly could be a buy and hold stock or a growth part of your portfolio. And it also has United Health. I thought it'd be interesting. I see this in a lot of mutual funds recently. I thought it'd be interesting to go through that So let's look at another popular mutual fund. This is T. Rowe Price Blue Chip Growth. They took Alibaba, Tencent, which are two Chinese companies, out of their portfolio, and PayPal. And let me see, they replaced that with Microsoft. Actually, this is what they have 6% more position in Microsoft. It was 5%, now it's 14%. And Apple is 10%. That's amazing. Did they? Yeah, they had 3% position before. Now they have a 10%. And Amazon is they have less Amazon now than they used to. And they got NVIDIA as a brand new position. So we see like a theme here. They're buying NVIDIA, they're buying more UNH and Eli Lilly. There's the three popular stocks in two totally different mutual funds. So, so I always get a lot of my long-term ideas from looking at changes in the mutual funds over quarters. So I thought it'd be interesting to go through United Health Group. We looked at that before, but I thought it'd be interesting to look at it again, seeing that they're establishing a brand new position with this. And you can see my screen from Fidelity. You can see that United Health screens as one of the top mega cap. It's like $500 billion in value, and it is as a return on equity of 26. Cash flow it matched some of the things we're looking for, but the PEG ratio is 1.73. So I like it when it's closer to 1. Or so we're going to look at United Health just for fun. Okay, United Health, I did the math and divided the earnings by the years. They're only growing at 10% a year if you add up everything. That's not very good. 10 to 12%, 10 last year and now 12% for the next 2 years. So and the catalyst that we have for Eli Lilly, not Eli Lilly, United Health is with an improving economy. We have a very strong economy now. The people end up hiring more people, and then there'll be more health insurance with more hirings. So I guess that's a catalyst. The one big problem right now that a lot of these insurers have had is they have expenses. They have expenses with people. They delayed their COVID. They had really good results in the COVID time because no one went in and got any work done because they were limited. And now all those people that didn't get their operations during the COVID time are getting their operations, and that's affecting their profitability. So, but they're growing at 12%. Their PE is 21. So that if you divide 21 by 12, you get a PEG ratio of 2. So they're 2 times overvalued. So every one of these health insurers are complaining right now of added expenses from people taking surgeries all of a sudden. And so I don't know. It's not that exciting. I guess whenever this gets to half the price it's at now, then I'll take a look at it as a long-term hold for my portfolio. Maybe when it gets down to $250 a share. Otherwise, it's not that exciting. Even at 12%, I don't know. That's still not that exciting. But you gotta look at it like the best mutual funds in the world are actually buying this, so it has to have some kind of credence. So we'll trust those people in the mutual funds. But United Health hasn't done anything for last year. It's kind of in a sideways pattern. That's another reason why I'm not excited about it. It's not in an uptrend. It's not going anywhere, and it's overvalued. So it looks like they would call this dead money. If you have something that's overvalued that's just going up and down and not going anywhere without being undervalued, it's not something that's really exciting enough for me to look at. All right, that was a good exercise. I I thought it would be interesting to go through a quick review of my theories for the stock market. These aren't right. These have just worked for me. And whenever I go over the stochastics, we'll go over those a little bit later on. I always follow a formula of, I draw a line at the top of a chart and at the bottom. Usually the stock chart actually follows a pattern. And at the bottom of the pattern, at the bottom of the channel, that's the time you want to buy. That usually, if you can match that when the stochastics are down to under 10, that's the perfect time to buy. And whenever the stock is at the top of the channel and the stochastics are over 90, that's the time you don't buy or sell. And I try to, right now, almost every stock we're following, it's at the top of its range. We see the S&P 500 right here at the top, and almost every sector. So that's not the time if you're putting new money into the market. It's usually not the time to buy. But right now we've been overextended for like months. So it's been overextended. So our stochastics really didn't help in the past 2 months. All right. So the other things are, whenever you invest, you have to try to balance your investments across different sectors so that whenever one sector goes down, then you're covered with other sectors. For instance, healthcare this year is doing really good. So whenever the financials in healthcare are doing good this year. So if you have all your money in tech and the tech goes down, then at least you have some healthcare and financials that are more conservative, that'll help your portfolio whenever you have a problem with one sector. So that is, this is how I've done my portfolio, and I try to keep, a certain portion of my portfolio in growth stocks and a certain portion in income. And my plan is, as I get towards retirement, I'm going to put more money towards an income part of my portfolio and less money towards the growth portion. And some people put it in bonds. I don't understand them yet. So, all right. So that was a good exercise. Let me see. Okay. The other things, I review this like once a month. The formula for purchasing reliable stocks that you can buy and hold. You'd usually like to have a stock earnings estimates that are solid like this in a straight line. We're actually, we're looking right now at UNH from a couple of years ago, but this, so we like to see it growing, and we like to divide the quarters and the years, and if they're growing over 10%, that's a good sign that they're going to be a buy and hold. But we see with a lot of stocks, if they're flat and the earnings aren't growing in the next couple of years, there's a good indication it's going to be like a flat stock that's not growing at all. Let's look at like our UNH. If we don't have earnings estimates going up, and you could see that as a symptom. All right. So let's look at the other things we look at. We look at the total debt, the debt minus total debt minus the total cash. And if it has a lot of debt, it'll be totally affected by the interest rates and any kind of blips in how much it costs them to borrow money. And return on equity, we like to have that greater than 12, profit margin greater than 12. And I just made these, I didn't make these up. These are just ones that seem to have worked over time for me. We like to have bigger companies, the market cap over 50. And the forward PE, we like to have low compared to the growth rate. So if the forward PE is 12, we like the growth rate to be over 12. So that means it's at least fairly valued. And we already measured the growth rate, dividing the years in the earnings report, our earnings estimates. And we like that to be greater than 10 in the PEG ratio. And we like to have it greater than equal to 0, 1 whenever, not greater than equal to. You want to have a PEG ratio around 1 when you buy a stock. Otherwise, you're overpaying for it. And sometimes you have to pay more for a stock that has high quality. And let me see. Let's look at other things. So let's look at, okay, let's look at our stochastics, just as the last thing we're going to do here. We haven't looked at these in a while. Okay. Okay, you can see this, the S&P, we're still at overbought. We've been overbought since for 2 months. You can see that we actually dipped a little bit on Tuesday. We went down in the stock market due to that PPI report, and we went down to this, let's zoom in on that. We went down to this bottom part of the channel. And so it's actually holding. We could have went down more, but we didn't. So you can see we have this new established channel in the S&P, and we're going to watch it. If it goes up to here, that's probably the max. But we don't know if it's going to go up to here. If it breaks out of this and it goes up to here, then we have a new uptrend. It goes up to this and to this. Otherwise, we're going to go back down to here. So I'm thinking we're going to go down to here for February because it's traditionally a bad month. And everyone's expecting good things on Tuesday. Sometimes whenever everyone expects NVIDIA to have good earnings, they buy in a rumor and sell on the news. So we're at peak expectations for a good earnings report. And if it just disappoints a little bit, then the stock market will go down. I don't know. We'll see what happens there. Let me see. Hold on. Okay, that's S&P. QQQ is the exact same chart. We're overbought and at the top of the range. Defense sector is basically sideways. You know, it's been like that for the past couple years, and we're overbought. Right. Gold, it's basically not going anywhere. It's still in this sideways pattern. XLY, consumer discretionary, is doing really good now. This is one of the ones that are we were tracking as a sector that did bad last year, but is doing good this year. All right, so now XLB materials, it's in a sideways pattern. So almost every one of the sectors we're following, XLC is maxed out, and most likely next stop is down there. Okay, you can see that XLB, this is the healthcare. It's breaking out. It was sideways for 2 years, and we were talking about this beginning of this year as possible, contrary, possible new leadership. And you can see a lot of the healthcare stocks like Eli Lilly are starting to go up. And if we look at our individual stocks, a lot of the healthcares are breaking out just like this. So it used to be a sideways, they paid a dividend, and now they're starting to be outperformers. So we're going to see if this continues its uptrend like that. And a lot of times whenever you see a sector going, being in favor like this, they've been out of favor for multiple years. That's a good indication you could start buying some of our watch list stocks that are in the healthcare industry. All right, so let's look at XLI. It's another one. This is Industrial Select. It's starting to break out of this sideways pattern, but it's still overbought. Let's see, XLP, nothing. Well, actually, XLP, the consumer staples, it's the bottom of its range, and it's near oversold. So that's a good indication that it's a good time to buy that sector. And you see XLF. This is this was out of favor last year, ever since the March closure of some of the banks. That is basically going sideways, and now it is following healthcare as being one of the more breakout sectors. This could be one of the best performing sectors. Let's see. XLU is still in a downtrend. I guess the problems with utilities are they have to borrow a lot of money to fund their operations, and so maybe with the high interest rates not going down as much, that could affect the profitability of these companies. I'm not sure. But we have a small little uptrend starting. I don't know. But it's down 3% this year. XLU, you see XLRE. Real estate. It's going sideways. I guess you have to wait for interest rates to go down before this sector, the real estate sector, recovers. You see XLE. This is basically sideways for the last year. The oil isn't going up, most likely demand problems. There's probably a recession coming in the world, so because of that, the price of oil and energy company prices aren't going to go up because of that. EWZ is near the bottom. No, it's near the bottom of its range, but it isn't oversold yet. Uranium, I just mentioned that earlier today. It's at the bottom of its range and it's oversold. So let me see. Okay, that was good exercise for that. And you can see a lot of the biotechs that we're following, or the healthcare stocks, and they're starting to break out of this long pattern of sideways. And AbbVie is example one. They pay a 4% dividend, and Abbott it didn't break out yet, but it's still stuck in the trading range. It's a healthcare stock. And Alibaba, it's probably why the company, the mutual fund company, got out of the stock. It's really hard to buy the stock in an industry where the Chinese government can make rules, and it's not fair. So we're following this just to follow the stock, but it's not very investable right now. Okay, Google is in an uptrend. It's had a really big downtrend this week, probably down 4% or 5%. But it's still within the trading range of this channel, and it's near the bottom of the channel. It's not oversold now, but I'm watching Google to see if it breaks out of this long-term channel. If it ever does that, then we have to go back and erase everything and start over again. But so far, almost every stock we're following has a well-defined channel. And Ultra is a down channel. You can see it's been going down for like 2 years now. And Amazon continues to outperform. I think Jeff Bezos sold $2 billion of stock this week in 2 days, and it still didn't affect the stock. That's pretty powerful. But it's still overbought, so it's still at the top of its range. So a lot of these tech stocks we're following are overbought. Apple, this example, it's at the bottom of its trading range, and I guess there's a new downtrend starting here. You can see that. And it's overbought. So let's see what happens with Apple. Okay, a lot of people are following Warren Buffett. Whenever Warren Buffett sells something or buys something, they sell it and they buy it. So they would have a tendency to sell this whenever Warren Buffett starts selling his Apple position. And we already talked about AT&T. Right, so Bristol Myers, this is, I lost interest in this like last year at this time. We're just following it because it's good to follow a company that's, it's like a poster child for a bad earnings projections. Let's look at that again. BMY. Yeah. So basically, if the earnings projections are flat or down going out a couple years, then it's people lose interest in buying the stock. So what I'm doing is I'm going to try to see what the earnings projections are. I'm thinking they're still flat or they're losing money. Correct. Okay, we're going to look at that while we look at the rest of these. Colgate Palmolive, they're actually starting a new uptrend here, and they're halfway between overbought and oversold. And CSX, they are also making a new uptrend in our channel. We're not signed in yet. And Meta, they had a well-defined channel here, but we may be starting a new uptrend there. This is one of the best performers in the stock market this year. All right, so let's look at the earnings estimates. 688, 7 what? No. You see, that's an example of a stock to avoid. if you're, this is in your portfolio for a growth stock, they're consistent on their earnings, but they're not growing. So until this goes up in a straight line, it was good for a while. You can see that these earnings, and now the stock price has gone down as the earnings estimates have gone down. So we're following this just as an example, this Bristol Myers, as an example of a stock to avoid, whenever the numbers change on you. Okay, is there any questions? Anything anyone wants to go over? Oh, Matthew, did you get my, did you hear my talk about super micro?
No, I was in another meeting at the beginning there.
Oh, okay. Let me go over that because I'll go over it again. Today super micro is down, it's down. Super. It's down 12% today. 17%. Wow. It's down 17%. So this is an example of a pump and dump stock. If we look at the 1 year chart, it's like it went ballistic, right? Parabolic, and now it's going down 17%. But if you see, let's look at the, I'm going to try to dig out hold on. I did another check on Supermicro. Okay, there it is. Okay, so it was up it was going up $100 a day. It's like 10% a day for weeks, right? And what I did was I looked at the, how much, first of all, we don't have many analysts covering this. They only go out 1 year from this year to next year. So you don't have a whole lot of, you should take that as there's not a whole lot of information to go on, a lot of confidence by these analysts to give an estimate beyond next year. So it grew almost 200% their earnings from last year to this year, but they're only scheduled to grow 33% this year. So that's a PE of 78. That's like 2 times overvalued. But the big problem is they don't know how accurate is this, and it all depends on NVIDIA and their earnings report that's coming up. So right now it's actually down. It's down 17%. Wow. So that's an example of a stock that it got to a point where it was a momentum stock. It's really, really dangerous. We were talking, it's really, really dangerous to 17% today, yeah. You put money in a stock that doesn't have a whole lot of history. Like Warren Buffett wouldn't invest in this because it doesn't have 10 years of history of a steady line of earnings going up in a straight line. Right now, all we have is, it went up a lot from last year to this year on AI, and possible 33% in next year. So, so this is a momentum stock, and it's being popped right now. So,
so it's really dangerous to try to go, buy puts or something, so you don't know how long the market's going to be irrational.
Oh yeah, right. Puts and calls are a way to, at a very, very low cost, protect your stock position, or you can, if you think a stock's going to go down a lot in a short amount of time, that is the least expensive way to try to take advantage of that. So we knew it was pretty, whenever a stock goes up in a parabolic way, it's super dangerous to try to, get in and out of it, because we're not traders and we can't figure those kind of things out. But I guess the best we can do is say, well, is it overvalued or not? And if so, what's a good time to start buying it? And I think reality is it's probably half the price where it's at now. So 500 maybe is probably a price. If you look at a chart, a lot of times if you draw a line, let's do that just for fun. Start. Okay, so if we have that chart there of super micro, and then you draw a line like that, that's a really big thick line, but that's okay. And if you draw the bottom of it like that, there's a good chance it would come back, like it would come back to here, right here, which is like 500. You see that? 500. That's its fair value. So that's how I would interpret it. If I'm vaguely interested in a stock, I definitely wouldn't chase it right there. I guess I'll put a point less than 1%, maybe 1/3% position in it right here if I truly believe in the company. Anyway, I thought that was interesting. This is an example of a pump and dump, and on Tuesday, it very well could go back up because NVIDIA might give some earnings that are stellar, and there's a knock-on effect for everything involved with NVIDIA, so this might go up with it. So we don't know, but right now it's super dangerous. Do you have any? Did you do any research on this, Matthew? Did you think it was something that I couldn't find? Did you find something else?
No, I was just on Supermicro. I just think it doesn't really have any moat. I think that NVIDIA has special technology that no one else has.
Mm-hmm.
But like Supermicro makes like motherboards and data center stuff that I don't think is actually like, there's no like long-term moat there that someone else can't be doing that same thing.
Right.
And I think that this sort of thing of like, no matter who wins, the servers are going to win, the server infrastructure providers are going to win, doesn't make any sense to me because it's just, there's no reason for there to be a margin there, like there is with the NVIDIA, pit chips, right?
Right.
So some of these things that are going up with AI, I think it just doesn't make any sense that they're way overvalued.
Right. So I agree with that. Anything with an AI on its name now goes up exponentially, just like .com went up. As soon as you put a .com on your name in 2000, it went up. So that's why, I'm avoiding almost everything but NVIDIA because NVIDIA also has problems with moat, even though it has like a 5-year, head start in a lot of this than other companies. They have competition coming up, like all the major data centers, like Microsoft, Amazon, Google, they're all making their own chips. And also they have competition from AMD and Intel. So, but how long are they going to have that moat? That's what Warren Buffett looks at before he invests in a company. He likes Gillette. They have a moat. They know 20 years from now, they're going to still have 20% of the shaver population, and so he would buy that stock. But it's very challenging with NVIDIA, and because we don't know how long they're going to be at the top.
Yeah, and so here is where I think that this is when there's an industry and there's a lot of stocks that are going up, or there's a trend, right? And some of those make sense, right? I think that some of those you don't want to necessarily like get in front of or anything, but you can say like, okay, I understand why the bubble's happening here. And then some of these stocks, I think that they are going up, and they are not. They're not part of that trend, and it's just there's no rational argument for their increase rate, right? And so I'm wondering if these are the sorts of trends where you think that I think that I can spot the market is incorrect, and it will. I think that will bear out at some point, and I don't think Supermicro deserves this like giant valuation, and it doesn't shouldn't be going up the same way that NVIDIA is. Even if the trend is correct, I think Supermicro is not actually part of that trend.
Right. Well, we'll see. We don't know. Maybe this time next year we'll be going back and they would have had 200% instead of 33% growth, and it's just very dicey. And I buy things that you can buy and hold for 10 years or more. and that doesn't seem like it has the moat to do that. But this as an example of proving a theory, there's a lot of one of my themes for this year is like the weight loss drugs, right? And I've been following this Eli Lilly, and Jim Cramer had this idea like 2 years ago. So I started nibbling at it, like, oh, that's a good theory. They had like a Alzheimer's drug, and they had this weight loss drug, and I try to match it out with, I know I'm paying double of what it's worth, but it seems like with drug companies, you got to take a little bit of a risk that some of their drugs will come out okay. But so I took that risk, and I'm like, there seems to be more evidence that it's going to have a decent moat. So that's what you do whenever you're investing. You got to like find stories, and then they have thesis, and then you have to like make sure that they prove it over time. And then you might want to invest a little bit more if the thesis turns to be true, you know. So,
yeah.
Anyways,
Yeah. And so I understand how to profit from that. Like, if as much things are dropping, I think that, one of these doesn't belong. I can buy that stock. It's why I think once things, the trick is when there's a bubble, it's harder to, I think, handle that situation in a safe way. So.
Yeah, I'm starting to think about, I've held Apple for like 12 years or 15 years, and there could be a bubble in this Magnificent Seven. So it might be a point in time where I start taking a little bit off the table and putting it elsewhere. So that's an example of that. I have to do something like that with my portfolio.
Okay. Well, I think we're over time. So
we're over time. All right. You have a good day too. Thanks for joining. See you.
Thank you, Greg.